Well, in FinStreet today, we decode how the Q1 FY22 has been for the banking sector. And joining me now is Vishal Goyal, Head of India Research at UBS Securities India Private Limited. Vishal, a very warm welcome to you on the show. Let's begin with the weak point that we saw in Q1 FY23 results. The operating profits were really on the weaker side. So how do you see the trajectory of operating profits and net interest margin for the banking sector going ahead?
Hey, hi Abhishek. So clearly, I think the quarter one margins were flattish. Plus, there was uh, OPEX growth in the quarter, partly also due to lower base. That also impacted the PPOP numbers on a YOY comparison. As we look forward, our view is that NIMs should expand for the segment overall. We are expecting anywhere between 5 to 15 basis point margin expansion. Large part of this should be driven by your loan mix change towards retail, plus banks are sitting on excess SLR, excess liquidity, which when deployed will add to overall margins. And lastly, the repricing of loan book, which would happen at a faster rate than deposits, that would also allow a transient margin expansion, at least in the next couple of quarters.
Well, you mentioned about retail loans. Loan growth in FY23 so far has been one of the best that we are seeing in last few years. So your view on loan growth trajectory, which segment or which product and what type of loans will drive the loan growth ahead?
Yeah. So loan growth pickup, which we are seeing currently, it's also from working capital demand. Retail has been strong for last many years, except the COVID period where we saw the disbursements, etc., slowed down significantly. Banks also went risk averse during that period. As we speak, I think the loan growth will be driven both from retail and working capital demand. Capex, I think, is still taking time, and therefore we are not estimating huge capex-led growth in the near term. Now, within overall, like within retail, if you see, banks are slightly better placed in terms of taking risk. So while they have tweaked their risk models underwriting during COVID, I'm sure now I think they are more comfortable with taking additional risk. So we would see once again unsecured credit to grow faster than the rest. Working capital demand, thanks to commodity prices, uh, and also I think the whole deleveraging on the corporate lending, that has also slowed down now, and therefore you would see the negative impact of deleveraging won't be there on the overall loan growth.
Just to explain our viewers, by unsecured credit that Vishal spoke, it is about those loans which don't have collateral like personal loan or credit card loan. So those are the unsecured loans on which, Vishal is speaking about. Vishal, the woes of credit cost or provisions for NPA that we know is now behind. Do you feel that? And also the fact that, restructured book is now below 2% levels. How do you see that also behaving going ahead?
Sure. So first on the credit cost, uh, as we all already know, corporate credit cost has been very high for last 5 6 years, and banks, depending upon which bank we're talking, at the industry level, credit cost was higher than 250 basis points per annum. It is now slowed down. In fact, quarter one run rate is 30 to 40 basis point lower than the full year forecast of the street right now as we speak. So there is a lot of cushion in the credit cost, even in the consensus estimates. That's number one. Then I think on restructured loans, historically restructured loans, have of course thrown more NPL compared to the standard book. Now the range has been anywhere between 25 to 40% of relapse, which happened in past. I think even if we assume something similar for this particular period, I think those outcomes will be within the consensus expectations.
Okay. Vishal, the next question is on the fact that, we are seeing bigger banks becoming much bigger and mid and smaller banks are losing market share to a certain extent. How do you read into this, that big is getting bigger and mid and small size bank are not able to cope up with the growth that we are seeing with large banks?
Generally, mid-size banks versus large-size banks, the key differential is cost of liabilities or cost of deposits, and that leads to different business models for different small banks or mid-size banks. Inherently, higher cost of deposit leads to high risk taking, or at least higher than the average risk, because they also need to justify a certain percentage of margin, and therefore the mid-sized banks typically becomes more cyclical in nature and more sensitive to macro cycles. So that is, I think, the key. Now, if we are going through a period of benign asset quality, benign corporate credit quality, then there won't be any huge differential between the mid-size or large-size banks. And also even on the retail side, for that matter, if the retail credit cycle is benign, which is what we are experiencing right now post COVID, you would not see huge differential in terms of performance. It's only at the time of either crisis or credit cycles you start seeing differential in their credit cost, leading to differential in their valuations.
Okay. One last question, Vishal. Anything that you noticed in Q1 which has surprised you positively, and how do you see that trajectory going ahead?
So I think the credit cost trajectory seems to be extremely benign. It was lower than street expectations, and therefore most of the earnings beat actually were driven from credit cost. Uh, as we speak, there is still scope within credit cost that concerns the earnings are still uh, expecting a 30 to 40 bips higher credit cost. So that is something we'll watch for, and that is the place where potentially upside risks are there.
Okay. Thank you, Vishal, for joining us. That's a word coming in from UBS Securities that, net interest margin going ahead will improve and credit cost will come down, which will drive the return ratios for the banking sector.